The stock market is signaling a likely short-term correction heading into the Fed meeting on Wednesday, which could be a buying opportunity because the macro data is signaling a new risk-on environment. Let's go over the data. Last week, we got the ISM Services PMI, which is arguably the most important leading economic indicator for the United States, and we saw a large 2-month acceleration heading into expansionary territory. We're also seeing the United States yield curve have a bear steepening since the end of October, which is where the long end of the yield curve is rising faster than the short end, which is the bond market signaling higher growth or higher inflation or higher growth and inflation at the same time. We also just saw the dollar break its bullish trend to now being neutral, which is a negative rate of change. Now, this trend break in the dollar is important because when taking a look at the rolling correlations versus the dollar on a 15-day basis versus all of these different assets like emerging markets, gold, oil, as well as commodities, the S&P 500 and Bitcoin, as you can see right now, they are all negatively correlated to the US dollar. So if the dollar continues downward, that will be good for risk on assets. And we're also starting to see risk on assets like Bitcoin get less bearish, which is a positive rate of change. Now, this is all just another iteration of the go phase of this no landing stop go cycle that we've been pretty much doing since 2023. Whereas in this go phase, there's an expectation of a dovish Fed, rate cuts, stocks do well in this environment, and we have a soft landing optimism. Now, the only problem with all this excitement in the go phase is that it typically leads to higher inflation expectations, which is a good signal to sell some or take some profits before we head into another stop phase, which is where you get a more hawkish Fed, a rate pause expectation. Stocks tend to have a little bit of a correction on that, and we have a lot of hard landing fears. Now, I do think we are in the early part of this next go phase, but we are starting to see an early indication of the bond market showing higher inflation expectations, with the 5-year break-even inflation rate having a large acceleration over the past week. And then also as well, when you take a look at the 10-year US government bond yield, ever since the Fed started cutting rates back in September of this year, we've pretty much remained flat to slightly up on interest rates. So they haven't even come down as the Fed is cutting. Now, even though the bond market is suggesting higher inflation and higher growth, the Fed is still set to cut rates by 25 basis points because of labor market fears, but they could have some forward guidance of a more hawkish type of tone heading into 2026. So we could see another hawkish cut like we saw back in September. And when taking a look at the technicals of the S&P 500 ETF SPY, during the past couple of weeks, we've had a bounce in price back to almost all-time highs on much lower volume. And so this is a classic bearish divergence and a classic sell some signal heading into the meeting.